This episode is sponsored by Lendlord. Lendlord is an online platform designed to help landlords and property investors manage, track, and optimize their real estate investments. Lendlord has a whole suite of free services, including a deal analyzer, property flipping calculator, tenant CRM, profit and loss reports, and so much more. I personally use Lendlord to track all my rental properties. Think of it as a modern day upgrade to boring old spreadsheets. Lendlord also has useful tools to analyze real estate deals, allowing you to calculate cap rates, IRR, and annual cash flows. It's completely free, so check out the link in the description below and let me know what you think.
Hey, Steve Saretsky here. Welcome back to the show. Lots to touch on this week. We've got an update from the Bank of Canada. We've got an update on the mortgage market, what's happening there. It's got some updates on the national housing statistics. Going to walk you through that, exactly what's happening in the data, but also what's happening in a lot of these markets. Going to walk you through that as we always do. We have to start this week's conversation off with the Bank of Canada. Of course, you remember, about a month or two ago, they moved to the sidelines saying, listen, we're now on pause. We're done raising rates, at least for now. We're going to wait, watch, and see the data, see how things progress, and make decisions from there. So this was the ongoing pause that they came out and said. Now, what's interesting to sort of unpack from this is really their conversation or their data that they put out from this pause, and which is basically was, listen, the labor market still remains tight, so we're still going to have to hold rates higher, potentially higher for longer, but we do see progress on the inflation side, and they are forecasting, they're forecasting CPI inflation, headline CPI inflation, to fall to 3% by this summer. And again, of course, if headline inflation falls to 3% this summer, assuming the Bank of Canada is actually right, that would naturally bring mortgage rates lower, bring bond yields lower, etc. And this is something that former BOC Governor Stevie Poloz came out in an interview calling for lower rates from here. Let's cue Stevie Poloz right now.
Therefore, there's lots to still happen in that anti-inflationary pipeline. And therefore, the vigilant place to be is the right place to be. My sense is that interest rates are more likely to be declining in the second half of the year. If it's not the central bank rates, it'll be the bond market that does that.
The one wild card here continues to be government spending. There's been lots of talk about it. Obviously, we had the federal budget came out a couple of weeks ago. Again, more spending. We had economists at the head of chief economist at Scotia. We just had one of the chief economists at BMO now this week come out and saying, listen, government spending, the excess spending continues to put upwards pressure on the BOC, basically suggesting that rates will have to likely stay higher for longer. There's a great chart here actually from Scotiabank's Derek Holt, again, their chief economist, showing the growth in public sector jobs, for example, under this current government, which has exploded. So basically what's happening is the government spending, the excess spending, is showing up in new job creation in the public sector. So the government is basically growing. The public sector is growing, more jobs, more cash being spent in, and that is actually reducing the labor pool for the private sector. So the private sector is basically running into these labor constraints, obviously having to pay people higher wages, because they're basically competing for labor with the government. So to sort of understand how those pieces work, and obviously when you're competing with someone for the supply of anything, prices tend to go higher, and so this runs the risk of higher for longer overnight rate from the Bank of Canada. Now, markets are still expecting, or pricing, I should say, markets are pricing one rate cut from the Bank of Canada by the end of this year. Again, whether that plays out or not, we'll wait and see, but those are kind of the implications. And so really how we take away what we look at basically we can see this starting to play out now in the national housing market. You guys have seen me talk about this quite a bit, which is we have some at least more certainty, more stability in the rates market, in the mortgage market. Basically we peaked out at, your 5-year fixed rate peaked out at about 5.5% in the fall of last year. And really since then it's come down. It's kind of moderated and balanced out and leveled out in the high 4s. And, with the Bank of Canada basically coming out and saying, hey, listen, we're on pause, the animal spirits have come out into the market and said, okay, maybe things aren't going to be as bad as we thought they were, and they're re-entering the housing market. Again, you can agree with that. You can disagree with that. You can think people are dumb, people are smart. It doesn't really matter what you think that's just what is actually happening in the housing market. And I would definitely agree that, what we're seeing now in the housing market is, again, we've talked about this, is the market is tightening up. We've seen this lack of new listings. If you look through the national housing data, you remember in February, I told you guys that, we had a 20-year low in new listings. Well, we just got the data that came out for the month of March from the Canadian Real Estate Association. Again, another 20-year low for the month of March. So it was the fewest number of listings for any March, dating all the way back. You had to go all the way back to 2003 when we saw this low of new listings. So basically what's happening is your inventory base is continuing to decline across all these major markets in Canada. And again, when inventory falls and demand picks up because they feel a little bit more confident with some rate certainty, we're now in a situation where multiple offers are happening across pretty much most of the product type in most of these major metro markets. So again, you can agree with it, disagree with it, say people are stupid. I personally look at it and say, well, it is surprising. It is surprising. Mortgage rates are basically still at 5%. Affordability indexes are off the charts. They're at extreme highs, which is basically the lack of affordability in the housing market. And yet people are willing to compete and push prices higher right now. If you look at the National Home Price Index, it made its first tick up higher in over basically a year. So its first month-over-month increase in the National Home Price Index. Now, keep in mind, you guys have known that I've talked about this many, many times. The National Home Price Index is by nature a lagging indicator. So really, the home prices have actually, realistically, they've actually been increasing since January, but it's now finally showed up in the national data in March. You'll continue to see it. It'll show up again in April and May, just because that's just how it is. It lags. And so looks like the peak to trough decline on a year-over-year basis, we would have peaked out at a 16% year-over-year decline, which I believe it was officially last month. That year-over-year decline is now shrinking. So this month we had 15.6% decline. Next month you probably see it as a 14% year-over-year decline, 13, 12, et cetera, until something changes. And what needs to change is a overwhelming growth in new listings and inventory. It needs to outpace demand. And so until that starts to happen, until the listings can accumulate, you're not really going to see any change in direction in the housing market. Now, what could cause a sudden surge in new listings? Well, that could be a deeper than expected recession, which creates job losses, which then forces listings onto the market. Again, still remains very, very much a realistic scenario. So it's something we have to continue to watch for as we move forward in the months ahead. But as of right now, the job market remains relatively tight. In fact, the Bank of Canada actually ironically increased their GDP growth forecasts in the quarters ahead. Basically, again, they are essentially predicting this very soft landing. And again, could be the things that fairy tales are made out of, but this is essentially how the data is starting to progress. And so, again, I continue to be extremely surprised, but we are in a situation where you have the macro going on, but at least locally, domestically here in Canada, we continue to throw the barn door wide open for 1 million new immigrants coming into this country. There's a great chart here on the number of new construction housing required to house immigrants moving forward in 2023. It shows basically the shortfalls, assuming that we have the rate of completions for new homes comparatively to 2022 versus 2023, and assuming that we import a similar number of people into this country, we're going to continue to have shortfalls of basically immigration outpacing the number of new homes completing. And again, this is just what the data is showing me. Again, could immigration flows change? You get deep recession, jobs dry up, people leave, immigration flows start to change. Again, very, very much a realistic and possible scenario, something that we have to watch for. But this is just what's happening right here, right now, is really against all odds. You have the housing market accelerating to the upside, mostly on a lack of new inventory coming to the market, which is leaving the market chronically undersupplied and people having to enter into multiple offers, thus bidding prices up, similar to how the government is bidding up wages for the private sector because the public sector is competing with the private sector. So again, supply and demand dynamics are playing out in many aspects of these markets right now. So that's kind of what I'm looking at here moving forward, things that we'll be keeping an eye on. And so, yeah, this is just basically what's happening in our housing market. So, as always, if you have any questions, feel free, leave them in the comments below. Shoot me an email. I'm happy to sort of dissect a lot of what's happening in the market. One thing I'll point you to before I wrap the show up is consider this. I still have the underlying larger macro thesis that are home prices really going up in the face of everything that's happening? Again, nothing really makes sense. Affordability is outrageous. Mortgage rates are higher. Why are home prices going up? Yeah, you got the micro stuff, supply and demand, but I can't help but wonder if some of this is part to do with this ongoing currency debasement that we're in. One of my favorite charts continues to be Vancouver real estate prices priced in gold. Remember, gold is money. It's been money for thousands of years. In fact, it was what backed fiat currencies up until the 1970s when we came off the gold standard. If you look at Vancouver real estate prices priced in gold, it's actually been falling. It's been falling for several decades now. So, and this is what I get most concerned about, is living standards are obviously deteriorating as the pace of home prices continues to grow, as basically the value of the currency and what it can buy you kind of fades away. And you can see this every day, obviously, when you go to the grocery store, you go to the coffee shop. I mean, I go to a Starbucks here in Vancouver, and it's $3.30 for a small coffee. What used to be $2.50 just 18 months ago. So it's all about trying to put a reference point into exactly what's happening. I still continue to believe, from a larger, bigger picture, that we have this ongoing currency debasement, which has not been resolved despite the short-term increases from central banks raising interest rates. We still have this, I think, really this ongoing currency debasement, and we're now against, again, all odds, seeing national house prices accelerating up again, I think is certainly concerning. So, as always, hope that helped. See you next week.